Good afternoon and welcome to this Yellowstone Advisory webinar with Halma PLC. I'm delighted to introduce both Charles King and Melanie Horton, co-heads of Investor Relations. So I'm now going to hand over to Charles to start today's presentation.
Thanks, Alex, and a very good afternoon to all of you, and thank you for joining. Welcome to this presentation, which we are streaming live, as they say here, from the boardroom here in Amersham. I'm here with Melanie, as Alex mentioned, my co-head of Investor Relations, and we'll spend about 20 minutes going through the full year results, or at least the highlights of them. It was a very good set of results, so we're super pleased to be here to tell you that story in a bit more detail. And then we'll have a bit of time for Q&A, as Alex mentioned. I know we've already got a few questions that have come through, so we'll work through as many of those as we possibly can. But you've got about 20 minutes to eat your spam sandwich or your sushi before we get to the questions. So really pleased with this set of results, as I mentioned. We announced them, as you're probably aware, about a month ago. We've been on roadshow since then, and we've delivered, really an excellent set of results. And our chief exec, Mark Ronchetti, made a comment actually at the results that this is the best set of results, or some of the best results he's seen in his 9 years with the group. I would say the same. I've been at Halma for about 7 years, and it's in that time, this is across the board, this is one of the best sets of results that I've seen. So it's a great pleasure to be here to present them to you today. So let me start with this introductory slide. It's a year where we delivered, again, record revenue and profit, and it's our 22nd consecutive year of profit growth. And if you think about all the things that have happened in those 22 years, whether it's the global financial crisis or COVID, it's a very impressive thing, I think, without patting ourselves on the back too much, to be able to say that we've grown profit consistently over that 22 years. So really pleased to see that. And for this particular set of results, it's really nice to see them underpinned by really strong organic growth. And that's trending above the long-term average. So on average, over the last 10 years, we've done about 7% per annum. And obviously, we've delivered more than that, as you'll hear from Melanie. We've also increased our margins and returns, and both of those metrics, importantly, are in the upper part of our target ranges. So they're very healthy anyway, but actually those ranges are very healthy anyway, but we're in the upper part of those ranges. And again, cash generation has been good. So we've had a track record over the last few years of having really strong cash generation in the business. And again, we delivered a number that's well ahead of our KPI. So, and that's super important for us because it enables us to make those continued investments in the business to support the future growth that we expect to deliver. So we've delivered all of that in markets that, as I'm sure you're aware, have been varied and fast changing. There's a lot going on in the world at the moment, and our ability to deliver this quality set of results and to deliver compounding and strong growth and returns in that environment, just increases our confidence in our ability to do more of the same into the future. And of course, importantly, that performance gives us the underpin for declaring a further dividend increase. We increased the dividend again by 7% this year. So that makes the 46th consecutive year of a dividend increase of 5% or more. So a real signal of the health of the business overall. Maybe we can move to the next slide.
I think that's mine, isn't it?
It is.
You were going to forget to hand over to me.
Yeah.
I get the pleasure of taking you through the nitty gritty. So as Charles said, we're really pleased to have delivered that strong growth and also increased our already strong margins and returns in the year. So as you can see on the slide, revenue is up 11% this year and EBIT up 15%. You're also seeing that increase to the EBIT margin. So the EBIT margin is up 80 basis points to 21.6%. And as I mentioned, returns being up, our return on total invested capital, or ROTIC, as we call it, is up 60 basis points to 15%. And then the next bit on this slide is around that continued strategic investment that Charles talked about. So that strong growth in those returns continue to enable us to invest behind the long term. So our companies are well invested. We invested 108 million in R&D, which is just under 5% of our revenue. So that's strong investment in the organic growth of the businesses. We made 7 acquisitions this year. 2 of them were standalone companies, so new companies that we're adding to the group, and 5 of them were bolt-ons for our existing companies. And we spent a consideration of 157 million pounds. Those acquisitions represent 3.5% of profit, and that follows on from the 8 businesses we acquired last year. We continue to have a healthy pipeline across all 3 of our sectors in terms of acquisitions, and importantly, we'll continue to maintain our discipline in acquiring only the best businesses. So that strong growth and the high returns are demonstrated by the strength that you can see here of our cash conversion and our balance sheet. That means we've got the funding for the future investment and growth. So looking at those metrics, it's fantastic to see the cash conversion at 112%, and that's well ahead of our target of 90%. Even with the combined investment of more than 300 million in the year through both R&D and acquisitions, our cash generative model means that our leverage, so our net debt to EBITDA, as you see on the slide, is reduced to just under 1 times. That continues to give us the firepower and flexibility to deliver on our M&A strategy. And finally, as Charles already mentioned, that supports that dividend increase of 7%. I'll next move on to our sectors and give you a highlight of the performance across all 3 of our sectors. So I'll start with our safety sector, our largest sector, which is 40% of revenue. The safety sector delivered another strong year of performance, building on the momentum of an excellent year last year. And really that performance was broad-based across our subsectors. So revenue and profit grew across all subsectors within the safety sector. On an organic basis, we saw good revenue growth that grew at 8%, and the sector delivered a double-digit increase in profit. So that was up 14% on a reported basis, which you can see. Actually, you can't see that on here because you can on the graph on the chart on the right-hand side of the page, and up 12% organically. It was also fantastic to see the environmental analysis sector delivering that strong revenue growth, as you can see on that page, that 18%. So delivering reported growth of 18%, and organic growth in the environmental analysis sector was 19%. That included very strong growth in what we call our optical analysis subsector. So that's our companies that use light to analyze, detect and sense materials. And the main driver for that was the exceptional growth that we saw in our photonics business, which continued to benefit from increased customer demand for digital and data capabilities. The growth in this subsector was also supported by the recovery in a number of spectroscopies markets. So those are our 2 businesses in our optical analysis subsector. The environmental monitoring subsector also grew well. That reflects a strong performance in our gas detection and analysis companies. And within the environmental analysis sector, we have a 3rd subsector, our water analysis and treatment subsector. That had a more mixed performance this year. Overall, the profit increased by 26% on an organic basis. Again, you can see that on the right-hand chart. Moving on to our healthcare sector. The healthcare sector delivered what we call a resilient performance given the subdued backdrop in global healthcare markets. That said, it was really good to see substantial progress in substantial improvement as the year progressed. So all 3 subsectors delivered organic revenue and profit growth in the second half of the year. And that reinforces our confidence in the healthcare end markets and also the long-term trends that support their growth. Profit, as you can see on the right-hand side, was 4% higher on a reported basis, and it was marginally up on an organic basis as well for the full year. I'll move on next to the businesses that we've acquired in the year. So these are the acquisitions that we made in 2025. As I mentioned, the 8 of them, those acquisitions increase the diversity of our portfolio, so they further broaden out our market presence across all 3 of our sectors. And looking forward, as I mentioned, we've got that healthy pipeline of potential acquisitions, and we've also made further investment in our M&A capabilities. So we've added a few people, a few skilled resources in our sector teams, and also in our dedicated M&A teams that support our dedicated our divisional chief execs who lead on acquisitions for us. It's also been great to see a high level of activity in those teams. They continue to be busy, and alongside our continued discipline in selecting only the best companies that fit with Halma. So I'll try and bring this to life a little bit by looking at one of this year's acquisitions, MK Test Systems, and I was fortunate to go and visit them last week down in Wellington in Somerset near Taunton. Absolutely fantastic business. Moving on to the next slide about MK Test Systems. So ensuring the safety of workers and critical assets has always been a focus for Halma. In fact, it was one of the first markets that we entered back in 1971, and that was through the purchase of Castell, an interlocks company, which is now part of our Centric Interlocks group. And over the years, that's broadened out to include solutions for new end markets. Examples include the use in renewable energy installations and also data centers. So our knowledge of safety needs in manufacturing and transportation, with those in mind, we identified a further market niche that we're really interested in, which is in testing the integrity and safety of electrical systems. And that led us to acquire VTech in Germany in 2022. And in May last year, we acquired MK Test. So why did we choose MK Test Systems? First, it's strongly aligned to our purpose, not only to safety, but it also offers opportunities to support electrification as part of greener energy use. And second, we see very long-term strong growth drivers underpinning the long-term growth. Electrical systems, as you probably know, are getting ever more complex and more hazardous with increasing use of high voltage systems. And as a result, we're also seeing that regulation increasing to protect workers and users. So in turn, that means that manufacturers have a greater need to automate that electrical testing to fill those regulatory requirements more efficiently. And in MK Test, we saw a company that had the specialist technology to help its customers, and also really strong customer relationships. So they've got companies such as Airbus, Boeing, Daimler Truck as customers, and that results in a deep understanding of their developing needs. So really importantly, we also saw that MK Test has an entrepreneurial culture. I really saw that when I went to see the team last week, and an absolutely fantastic team, really welcoming, really transparent, and really open and I guess really excited to showcase their business to us. And they've got an ambitious and growth-focused leadership team, and that fits well with the culture at Halma. So all of those elements give us confidence that MK Test can continue to deliver that strong growth and superior growth margins and returns for many years to come. With that, I'll hand back to Charles.
Thanks, Melanie. So let me sum it all up in 3 slides, and then we'll move to Q&A. And let's start with a slide on the KPIs that we run the business to. And you can see it was a strong performance really right across the board on these KPIs. So we're well within the range, or we've exceeded all of the KPI targets on this side, except for one, which is the M&A target. And at the same time, we've continued to invest for sustainable long-term growth, both organically and through acquisitions. So it's worth just looking at that, 9% plus organic revenue growth against a 5% KPI target, nearly 13% organic profit growth against a 5% KPI target, in the upper end of the adjusted EBIT margin range, 14% EPS growth, over 14% EPS growth against a 10% KPI target. Still investing very well in R&D, well above the 4% threshold that we set. And as Melanie mentioned, the cash conversion and the returns very strong as well. So very pleased with that. It is worth just spending a moment on the acquisition piece. It's worth saying that in this particular year, we only delivered 3.5%, but over the last 5 years, our acquisition profit KPI has actually averaged 6% above our 5% target. And that really reflects the timing and nature of the acquisitions that we make, the lumpiness, if you like, that we can experience in the way that we do M&A. And I'm sure we'll talk about that a bit more in the Q&A. So super pleased to see all of that and see that performance right across the KPIs. And, obviously, ultimately, at the end of the day, that kind of performance is creating significant value for our shareholders. So let's move on to the next slide and think about how we look at FY26. Remembering, by the way, of course, that we're a March year end. So we've already about 3 and a bit months into the FY26 year. We've made a positive start to the year, importantly. And we've got a strong order book. And at the time we reported, order intake was ahead of the revenue that we were generating and ahead of last year. So that's a pretty good start to the year. Obviously, we are continuing to see geopolitical and economic uncertainty. I think that's almost a truism now, and maybe it's more intense than we've seen. But even with all of that, we're expecting to deliver upper single-digit percentage organic constant currency revenue growth. And that does include, of course, a premium from further very strong growth from that photonics business that Melanie mentioned. And our adjusted EBIT margin is expected to be modestly above the middle of our 19 to 23% target range. So again, probably pretty similar to what we saw in FY25. So really, in summary, looking for another pretty strong year in FY26, despite all of that uncertainty out there in the broader world. And then just turning to the very last slide, there's the track record over the last 10 years. I love this slide. I think it's absolutely what Halma is about. It's about delivering compound growth and obviously compound very strong returns over a long period of time. And that consistency of growth that we've delivered over the last 10 years is highly apparent here. We've delivered that through economic cycles, through large global events, shall we say. And I think that track record demonstrates the benefits that we get from the diversity and agility that's inherent in what we call our sustainable growth model. And that's it's now very much a proven model whose fundamental strengths have sustained that track record for more than half a century. It's a model that I think that the strength of that model supports that confidence that we have, that we're well positioned to make further progress this year and, of course, importantly, over the longer term. So with that, I'll hand it back to Alex, and we'll move on to the Q&A piece of the presentation.
Thank you very much, Charles and Melanie, for that presentation. And again, congratulations on what an impressive performance in terms of the consistency of the profit growth. I think you said 22 years consecutive profit growth, and now the 46th year of more than 5% of dividend growth. So very impressive performance. We are going to take some questions now. So please, if you do want to ask a question, please type it into the chat box at the bottom of your page. Now, we've had a couple of questions on this topic, so I'll start with this one. as regards the tariffs, the Trump tariffs. So what adverse effects will President Trump's tariffs have on Halma?
Want to take that one?
Yeah, sure. Absolutely. I mean, it's worth going back to the strengths of our model when we talk about the impact of tariffs. But I think if we look in terms of how we're organized as a business, and in the US specifically, we tend, sorry, across the world, but when I talk about the US, we tend to have a local to local model relative to some of the more globally integrated companies that you might look at. So in the US, around 90% of our revenues originate in the US. So we're manufacturing in the US and selling into the US. So that's 90% of those revenues. But of course, if we look at our model and how it works, agility is a really strong asset for our companies. So they're able to respond quickly to challenges and opportunities, and that means that they can take a range of actions across their supply chain, their manufacturing footprint, and where appropriate, also pricing. And so we do have that pricing resilience if it's needed. So our products are sold on the value we offer to customers. It's not a margin over cost model. And our companies also tend to have leading positions in their niches. So they operate in high value niches. Again, that gives us a high degree of pricing resilience. So that said, I guess, broadly, we do also need to look at those direct revenue impacts versus the more indirect impacts, as you see those tariffs being rolled out, and they're still changing on a daily basis as to what's going on with those tariffs. So we think we're relatively well placed, but again, it's very difficult to see that look through on the economic uncertainty that these increased tariffs are going to have. So while we're confident in the model and what we can do, we believe we're more resilient, not necessarily immune to those wider pressures.
Thank you. Next question here is on a question that's been asked many times about Halma, which is acquisitions have been a key part of the growth strategy for Halma. Is it getting more difficult to find good acquisition targets at a reasonable price?
Or maybe if I take that one, I think actually in some ways it's getting easier, but we've certainly got plenty of companies that we think we might want to buy in our pipeline. So Melanie mentioned a healthy pipeline, but maybe to put a number behind that, there's probably at least 600 or 700 companies that we're tracking in our pipeline. And as a reminder, we bought 7 last year. So the key is actually not the opportunity set for us, it's maintaining the discipline and only buying the very best out of that opportunity set. And there will be some timing effects, as we saw in the last year. So in the last year, we didn't hit our KPI, as I mentioned, on M&A. We have done on average over the last 5 years. In fact, we're a bit ahead of it. And that tells you we've got healthy momentum in M&A, but in any one particular year, the timing of individual transactions might mean that that M&A doesn't necessarily come through within that particular financial year. But if I take a 5-year view, I'm very confident with that very healthy pipeline that we will, that we have a really strong opportunity to hit and exceed the KPI.
Thank you, Charles. Next question here. Do you believe that the recent Supreme Court judgment on the meaning of sex in the Equality Act has affected or might affect any of Halma's policies relating to staffing, procurement of any other area? I ask because in recent years, so many companies have adopted internal policies that are now clearly or potentially discriminatory and unlawful.
Okay, well, maybe if I kick off on that one and Melanie can drill into a bit of the detail, but Halma is very diverse and inclusive in its culture, and I think that's not only a huge commercial asset for us, but it actually makes it a great place to work. And we've been working at that, for really quite a period of time. But Melanie, do you want to pick up on some of the detail on what we have been doing?
Yeah, sure. I guess, we began that journey to build more inclusive businesses over 10 years ago. And we think that Halma's performance during that time speaks for itself. As Charles said, we think it's a great asset. Our diversity is a great asset. And so I think our success demonstrates that building inclusive businesses helps you to win. We're keen for Halma to become a magnet for great leaders. We've won an award for gender balance last month at the senior leadership level. It's called Balance in Business. You know, and I think there's probably no silver bullet about creating the right culture to attract the best people. It takes time. But again, you know, so we've got 52% of our senior leaders are women. 50% of our executive board and 75% of the Halma PLC's board are women as well. And then actually our graduate scheme called the Catalysts, 50% of those are also women. Beyond, I guess, gender diversity as well, we're also focused on ethnic diversity throughout the group. I guess we're pleased with that progress, and we continue to believe that that building a diverse and inclusive culture throughout our portfolio of companies is very important. And in fact, we have a KPI target at group level. It's around increasing that representation of gender equality on our individual company boards. So committed to our diversity, equity and inclusion culture, as it were.
Yeah, absolutely. I just think it gives, ultimately we want to be a magnet for great leaders, and having a very diverse and inclusive culture gives us that magnet.
Thank you. Very, very encouraging. Next question here. Every year I wonder how long you can keep margins up in the 20 to 22% range, and you keep delivering. But I still have the same question. How long are these margins sustainable for?
Okay, well, maybe if I take that one. I think we proved that we could do it again for another year in the last year, as I mentioned. So that's another proof point, if you like, and it's been very consistent. Why are we delivering very healthy EBIT margins in the business? And yes, of course, part of that is driven by our companies running themselves efficiently and all of those things. But fundamentally, it's about the value that we deliver to our customers. So if we deliver really good value to our customers, they're going to pay for it. Basically, it's as simple as that, and we will earn healthy margins. How can we make sure that we continue to deliver good value for our customers? Comes back to that point of investment in the business. So if we invest well in the right products and the right services that our customers want, then we will earn a healthy margin for those products and services. And that's what will sustain it. We'll be in a virtuous circle there. We'll earn good money for delivering those, fair money, if you like, for delivering those services and products for our customers. And that in turn, that profit momentum and that cash momentum will enable us to invest for future margins. And we've set a target range of 19 to 23% for EBIT margin. We're very healthily within that range, and frankly, I'd expect us to continue to be so.
Thank you. Next question here about a geographic split. Geographically, since 2021, the USA has increased significantly as a proportion of group revenues from 39% to 46%. Do you see this proportion continuing to increase? And if so, would this influence the choice of your reporting currency?
Okay, well, maybe if I kick off on that and then Melanie can give her thoughts. Fundamentally, we don't really manage the business geographically. So if I was being very flip about it, I'd say the answer is I don't know. We will put our money, we will invest where we see the best opportunities for growth and returns. So we are agnostic geographically, and we have no particular target to grow in one region or country over any other region or country. Okay, so the growth that we've seen in the US in some ways is an accident of growth opportunities, both organic and acquisition growth opportunities that we've seen over the last several years. So I don't think there's anything I can tell you in terms of prediction in the future. What I would say, though, is that we're very happy being a UK listed company and reporting in sterling. That's our history, that's our continuity. And when I talk to shareholders, they have no desire for us to switch into being a US dollar reporting company. Melanie, anything else to add to that?
Yeah, I think just adding a little bit of color in there. So as we acquire businesses, sometimes we are seeing more in the US. I think we've seen a good spread this year and last year as well across all of our geographies in terms of the businesses we've acquired. I think in healthcare, we have a larger proportion of our revenues that are biased to the US. You might expect that given the spend on healthcare in the US is a large portion of the developed market spend in healthcare. But actually, when we look at the acquisitions that we've made in the healthcare sector over the last couple of years, the new businesses that we've added to the group, interestingly, so about 2.5 years ago, we added IZI Medical in the US, which does biopsy needles, markers for radiation therapy for cancer diagnosis and treatment. They are based in the US, but then after that, the last 2 years, we've acquired a bolt-on for them in Sweden, Apriomed, again, doing biopsy needles for cancer diagnosis. We've acquired a cervical cancer a brush maker based in the Netherlands, a business called Rovers Medical. And our last acquisition in healthcare was in France, a business just outside Paris called Lamide Nouri, which they have electrosurgical devices, so used for minimally invasive surgery around urological and gynecological surgeries. So again, quite a broad spread of where we see opportunities globally, also reflected in our acquisition activities.
Next question here is, in which of the sectors where you operate are the most attractive market dynamics currently?
All of them. So the way I look at it is currently is perhaps not the right word, because actually for us, it's about more than anything, it's about medium to long-term growth drivers within the businesses. And we're very excited about the opportunities that we see across our three sectors, because they are driven by very fundamental and very significant problems, frankly, very, very large issues for the world. And if you go back to safety, it's about industrialization, it's about urbanization, it's about more crowded and automated places and keeping humans safe in those environments. So the interaction, if you like, of humans and machines is becoming ever more complex, and we need to keep people safe as they interact with those machines. And spaces are becoming ever more crowded, so we need to keep human beings safe as in that as well. Healthcare, for example, I think it's a truism, but there are more old people, there are more complex and chronic health conditions to deal with. The ability to diagnose and treat those health conditions is growing all the time, and healthcare providers need our help in doing so really efficiently as well, to deal with all the backlogs that are out there. That's a problem that's not going away anytime soon, and is certainly been growing over the last few years, particularly, I would say, since COVID. And then I think the environmental and analysis space, it's very obvious. We've had pressures on natural resources, pressures of pollution, maintaining clean water, maintaining clean air, for example, over that period of, over a long period of time have been issues. And I think that those issues are being compounded by the increasing pressures we're seeing from climate change as well. So, I think we're excited about the opportunities in all three sectors to tackle some really fundamental and very important and very long-term issues. And that's what's going to feed the growth for Halma. So actually, currently doesn't really cut it for me. It's about the excitement that we have in the ability to grow over the next 1, 2, 3, 4, 5 decades. That's actually what I think is exciting about Halma.
There's quite a good segue into the next question then, Charles, which is why were healthcare results so poor last year, and what is the outlook for this division?
Yeah. So, well, maybe if I kick off on that one, and Melanie can chip in. But what we saw in healthcare was very strong growth, as you might have expected, in some of the areas, some of the companies within healthcare in sort of during COVID and then the subsequent supply chain issues post-COVID as well. So we saw exceptional and probably sort of over beyond average growth in some of those areas. And to some extent, over the last, 18 months or so, Melanie, we've seen a bit of a backlash to that. So we've seen budgets in healthcare cut. We've seen some of our OEMs, so some of our sort of corporate clients within healthcare to whom we're selling component parts that they might use in one of their own products. We've seen them cut their stocks, cut their product launches, for example, as well. All of this is really just a reaction, to my mind, to what we'd seen, a few years prior to that, which is very significant budget increases and a very substantial expansion among some of those OEM companies. The good news is, as you heard from Melanie, is that we're seeing normalization in that, I think. Certainly the second half of FY25 was much stronger than the first, and we saw healthy growth in both revenues and profits in the sector. And I'd expect that trend to continue as we go into FY26, even with some of the uncertainty that we're seeing in the US market around some of the reforms that the Trump government are putting through in Medicaid, for example, and some of those areas. So it's an improving trend. I think, having had a tough 18 months and performed very well, I think, given that tough general market background, the good news is that we saw, much better trends in the second half of the year. And hopefully that will continue through, we'd expect that to continue through FY26. Anything else you'd add to that, Melanie?
No, I think just echoing what you said, but I think if we look at the majority of our companies in our healthcare sector actually started performing pretty well, particularly in the second half of the year, but a number of them have had a very good performance. And so we're still seeing a few pockets of maybe where we're still seeing that, I guess some of our larger customers having a bit of a slowdown, or they're working through their own stocks, and that's starting to recover. But some of our other companies performed very well in the year. So it's not necessarily visible in the headline numbers, but actually that gives us a lot of confidence moving forward that recovery is starting to come through, and really pointing to those wider healthcare market challenges that we've seen over the last 2 years. Actually, our healthcare portfolios performed pretty well in comparison to some others, and importantly, we've remained well invested, so continuing to invest in R&D behind that medium and long-term growth in healthcare.
Wonderful, thank you. In terms of current trading, are you more or less positive about the prospects for the year now compared to the start of the year?
Well, we'll tell you in September how we're doing, but I mentioned that we'd had a positive start to the year, so I think that's probably, I'm not going to give weekly updates on how trading is. Clearly, if anything had changed materially, we'd be required to update the market. So, but we had a positive start to the year. We've given the guidance we've given for the year, which is certainly for another strong year of results. So, and we'll update you as we usually do at our trading update, just towards the end of September, and then obviously at the half-year results in November.
Great, thank you. Who are your major competitors in the 3 different fields, and is Halma the price leader?
I'll have a go at that one. Get me into the nitty-gritty. I guess overall, we wouldn't have a main competitor. So each of our individual companies will have their own competitors. And often, because we're operating in those narrow niches, it will often be other small private companies that they compete against. However, on the other side, their customer list tends to be very blue chip, so global companies that you've heard of. So they're competing for often quite a small pot. And they'll have other competitors that you haven't heard of. So we don't have necessarily one, I guess, major competitor across each of the three sectors, because we operate in so many different niches within each of our sectors. That's probably the best way I can grapple with.
It will be very diverse, very, very diverse. And, you know, as Melanie said, it's often small privately owned companies that we're competing against. And I think that gives us an innate advantage as well. So our companies are a bit like those small privately owned companies, but of course they've got the advantage of being part of a FTSE 100 group as well. So we've got all the agility that our individual companies have, all the agility that comes from being a small company, but all the advantages of being part of a larger group. And that's a really winning combination in those marketplaces.
I just realised we didn't answer the second part of the question,
which
was on, does that give us, I think, a pricing advantage? I think, you know, look, the way that we look at pricing, most of our growth is actually delivered through volume growth rather than pricing. So historically, if we take our 7% organic growth that we've delivered over the last 10 years, around 5 to 6% has been through volume growth. So our company is growing and growing within their niche, but also finding markets adjacent to their niches to grow into. And then 1 to 2% has generally been through price. So we do operate in those high value niches. So those products have a high value in use to our customers. So we do have good pricing resilience, but again, always conscious to not exercise, I guess, price gouging our customers is not something we want, because we value our relationships with our customers.
Thank you very much. I think we've got 3 questions outstanding. We've probably got time for them all, so let's see if we can take them. First one is, can you tell us what consensus expectations are for earnings and dividends for FY26?
You've just published an update, haven't you, Melanie?
Yes, yeah. If you looked at the website earlier, it might not have been quite as up to date, but we have just updated it on our website. So you can actually find consensus expectations on the investor section of the Halma website. So for FY26, actually consensus has us delivering over £1 of adjusted earnings per share for the first time. So adjusted EPS for FY26 consensus has it 100.5p. And the consensus expectations for the dividend is 25.2p for the full year 26.
Great, thank you. Next question here. You've highlighted electrification as a strong growth area. What other areas associated with climate change do you think present growth opportunities for Halma?
Oh gosh, there are many and varied across the group. I mean, maybe just to pick one or two out, and I'm sure Melanie will have a couple on her mind as well. But the obvious ones are within environmental and analysis. So we have just probably close to 10% of our revenues coming from water. So all things water, really. So water testing, water leak detection, working in the wastewater space as well. So inspecting the integrity of wastewater pipelines, fixing those pipelines if they're broken, and looking at some really good opportunities around that. So, you know, water is an important part of the business for us, and obviously, you know, very much geared to that. Probably about 5% of our revenues is in gas detection, and again, critical. You know, thinking really there are probably 3 parts to that area for us. You know, acute exposures, often in an industrial setting. So making sure that, you know, bluntly, somebody isn't harmed through the release of a noxious gas in a industrial environment, or a refrigerant gas, for example, in a commercial environment. The second is chronic exposures, so making sure that people are safe over time in those sorts of environments. And that takes us more broadly into atmospheric exposures as well. So making sure that all of us have clean air to breathe, and that we're not harmed by breathing the air because it has something in it as well. So those are the two of the obvious areas that we think about, but there's many others, I would say, across the group. I mean, Melanie, you've probably got a few on your mind.
Yeah, I think if we think about, even our safety sector, which may not be quite so obvious in terms of climate change, but as we see, increasing instances of climate change related disasters, whether that be wildfires or other things, there's opportunities for us for some of our portfolio companies to move into things like mass notifications, how to keep people safe in urban settings, and think about that safe evacuation as well. So lots of opportunities that we are setting ourselves up for around not just the environmental analysis sector, but also more broadly across the portfolio.
Yeah, and things like
healthcare as well.
Yeah, things like fire suppression in wind turbines, for example, fire suppression in battery energy storage. So each of our individual companies are thinking about those opportunities. When we aggregate them at the group level, we get really quite excited about those opportunities and our ability to help people think about the transition to cleaner forms of energy over time.
Great, thank you. And one last question, and it's a very topical question. Do you have an AI strategy, and is that driven centrally, or is that evolving at a divisional level?
Okay, well, as ever with Halma, it's a bit of both. Or maybe Melanie can give a bit more detail, but I think we're quite excited about some of the opportunities. Obviously, they need to be governed correctly. But Melanie, why don't you go into a bit more detail?
Yeah, so I guess how AI is adopted is going to vary quite significantly by company, given the types of different technologies and products that our companies have. So it's really up to the individual company to determine their approach in terms of the product side and their operations as to how AI fits within that. But as Charles said, obviously within our group governance and framework for using AI. But and what we also do is we ensure that the learnings that we get from any of our companies where they're utilizing AI are shared more widely across the rest of our businesses as well. So we have developed with some of our companies as a pilot a Gen AI based customer chatbot to help essentially customer service agents address some of the really complex queries that they might have in some of their products, rather than having to call an engineer off the field to delve into the minutiae of detail in a manual. Actually, that frees up their time, and we're able to get the Gen AI chatbot to actually find that information that's needed and deliver it to the customer quickly. And so we've developed that, and we've launched it with I think another 10 of our operating companies. So that's something that's partnered between the companies and centrally. So I guess that's that hybrid of both approaches. And we seem to have another number of companies that are keen on the uptake of that. So that's just one example of some of our companies are doing there in terms of AI.
And really taking the technology expertise we have at the centre, allowing companies to pick what's right for them, but then also, a really healthy feedback loop around all of our individual companies collaborating, and also feeding their experiences back to the centre so that we can again, create what's most useful for them.
Great. Thank you very much. We have no further questions here. So that brings us to the end of today's webinar with Halma PLC. We're very grateful to Charles and Melanie for spending the time to engage with private investors. So thank you very much for that. And please, to the investor community, as you exit today, there'll be a short survey to complete, and we'd really appreciate it if you could just spend a couple of moments completing that so we can provide some feedback to Melanie and Charles. So look, thank you very much for attending, and we hope to see you soon.